Hi, everybody. This is Mark, and welcome back to another episode of Beyond Profit, a global perspective. And today we're going to talk about interdependence. We talked about this a little bit when we talked about liberalism, but I want to talk about it more from a slightly different perspective. What we mean by interdependence is that countries are becoming increasingly more interactive through globalization. That means more economic and technological transactions, more military and economic cooperation, and as a result, international actors are more sensitive and vulnerable to others in the international system. This could be a good thing. The United States and its allies are less likely to attack each other militarily, perhaps because of this interdependence that we have, and more likely to cooperate with each other along a whole lot of different dimensions. But it is also perhaps risky and dangerous from the standpoint that if there's a crisis in one country, it may affect all of the other countries that are connected to it. As we sometimes mention, given the United States' size, when the United States sneezes, the rest of the world catches a cold. If liberalism illustrates the benefits of interdependence, government policy illustrates its risks. In this video, we're going to talk about the risks of interdependence by talking about several topics. The first one is we're going to continue our conversation about currency. I know there have been a few currency videos out there, might cause you to start thinking a little bit about issues like this, but we're going to talk about a couple of cases of currency integration and how that's illustrative of the benefits and perhaps the risks of interdependence. Second, we'll talk about the risk of national debts. Third, how fiscal policy may sometimes challenge the liberal order and how governments work together in order to try to manage that conflict. And finally, we'll talk about China and how it has exploited the globalized world through currency and foreign trade. So let's do this thing. So I hope you all appreciate these videos. Obviously, a lot of these videos are focused on my students, hopefully to help them in their classes. But maybe if you're taking some classes that are similar or you just want to learn about the world, a globalized world and international business, then you'll get something out of this too. And if that's the case, I ask you to please share, subscribe, support this channel. It really helps me out in terms of justifying the amount of time that I take doing these things, and I want to continue to try to be able to provide these for you and help you on in the future. So as I said, we're talking about interdependence today, and as I mentioned, currency systems are illustrative of interdependence. So we're going to look at a couple of currency systems as case studies, specifically the collapse of the global fixed currency system from the Bretton Woods system, and also the near collapse of the euro. So what happened to the fixed currency system? If you remember from the liberalism video, we talked about the Bretton Woods system. We talked about the World Trade Organization, the World Bank, and also how a fixed currency system was established from that foundation. And the original purpose of the IMF was to regulate that fixed currency system. So it was meant to foster orderly foreign exchange arrangements, convertible currencies, and to help states with balance of payment issues. So the IMF would provide assistance to countries if there was an unmanageable balance. Let's look at this chart for a moment in order to illustrate how this might hypothetically work. So you see a table of balance of payments, right? So that's basically how much one country owes another when it comes down to trade. So you can see that in this very extreme example, the UK has purchased 100 units of stinky cheese for £2,000. France has purchased only one bottle of paracetamol for €2. So the UK owes £2,000 to France. France owes €2 to the UK. So there's a massive imbalance, a trade imbalance between these two countries. We can mess with the conversion and so on, but the bottom line is that the UK now has a very significant trade deficit. Remember our talk about currency. What happens when you have too much currency floating around an economy? Creates inflation, devalues that currency in the country. So when you have a situation where the UK has a massive trade deficit to France, then that means more money is going to be floating around France, which means that, at least hypothetically anyway, their currency should drop and they should have less buying power, which causes inflation. Countries' currencies can't float when they're in a fixed currency system. And so as a result, they're not supposed to float around. Yet when you have imbalances of trade, there's pressure for that to happen. And so that's what the IMF was supposed to try to do, is offer loans and financial assistance to countries so that that imbalance wouldn't adversely affect this what was supposed to be a balanced currency relationship between these different countries. So the IMF wasn't completely effective at maintaining that balance, and countries started to perceive that this imbalance of trade may mean that there's an imbalance of wealth. Gold isn't easily movable. If I'm going to have confidence in the system, I have to have confidence in gold, and that gold is being held largely in Fort Knox. While gold is a fairly universally valued asset, it also is still subject to the law of supply and demand, and so as gold prices fluctuate, so do the perceptions of the stability of anything that's also tied to gold. Before I talk about how that system broke apart, let's fast forward to the future. About 2008. In the meantime, the EU has a fixed currency system that has been established since about 1999-2000, and it's been formalized by basically the abandoning of their previous currency and the embrace of a new set of currency now. It's been completely institutionalized. 2008 was a big year because the financial crisis that rocked the United States rocked the rest of the world as well. And it caused bankers to have questions about countries' abilities to pay off their debt. So there were a number of European countries that got themselves into trouble in terms of debt. Greece, Spain, Portugal, Italy, Ireland. All of these countries were potentially in trouble. And the reason why they were in trouble is that they borrowed lots of money and their tax base wasn't able to keep up with that. Take Greece, for example. It's, I think, really illustrative of the issue. So Greece relies on a lot of money in its economy for tourism. So imagine a 2007-2008 financial crisis where a lot of the people who might be going on holiday to Greece aren't going there anymore. That causes a real dip in their economy. And in the meantime, you've got bankers who are saying, hey, I wonder whether or not Greece is good to pay it all off. Big bankers started expressing concern that maybe these countries weren't going to be able to pay off their debts. Everyone's confidence in the euro started to decline. Think about this. If the value of your currency goes down in Greece, large economy countries like France and particularly Germany start to get nervous too because their currency now has gone down. If that happens, that means that you could have a euro crisis. That is maybe confidence in the entire enterprise. The very currency itself might be undermined. And so countries got together and started thinking about, hey, how can we pull this together? How can we keep this thing going? The answer came from Germany, who agreed to actually bail out Greece. Can you imagine how that goes over with voters in Germany? Angela Merkel, the Chancellor of Germany, tells the German voters that we're going to take your tax money and we're going to use it to help bail out Greece. You're probably looking at this situation and saying they were perhaps irresponsible with their money and they can't raise taxes. Like, why are we doing this? How popular do you think people were who were trying to advocate that? But they believed in the larger mission and in terms of keeping up interdependence and the values of interdependence. So they invested in it. There were some political challenges, but Angela Merkel held in there. And as a result, the euro was saved. It eventually stabilized, and it's still a viable currency to this day. Hypothetically speaking, let's say that the source of the euro problem wasn't Greece, but Germany. Let's say that people lost confidence in Germany because for whatever reason, they didn't have the tax base to support whatever borrowing they had done. What do you think would happen to the euro? Well, who's going to bail out Germany? That's the big question. Simple answer is nobody, because Germany's got the biggest economy in Europe, and all of them combined probably couldn't come up with that money. And if Germany's got those problems, then you can guarantee that other countries that are smaller probably did too. In short, it's very possible that the euro could have fallen apart and this whole project, this European project, could have been seriously undermined. So here's the link back to the Bretton Woods fixed currency system. We just asked the question, what would happen to the euro if Germany had been the cause of the problem? And the answer is the euro would probably fall apart. Well, in the Bretton Woods system, what would happen if the United States was the problem? And the answer to that is we were the problem. US fiscal policies put a lot of tension on that fixed rate system. So consider the years 1965 to 1968. There were macroeconomic packages, some of which were supporting massive poverty relief, Great Society programs, things to try to improve the social fabric of the United States and support its safety net. That required a lot of money. At the same time, we had a massive war going on, maybe not massive in terms of global scope, but in terms of money spent, the Vietnam War. Now, as the United States is spending more and more money, particularly on the Vietnam War, that means that loads of US dollars are floating around the world economy. In the meantime, what's happening to the value of the US dollar? Well, as we said with supply and demand, that's going to cause pressure for it to go down. So if the value of the US dollar goes down, it creates pressure for what? For all of the other countries that are tied to the US dollar, their currency to go down as well. Just like in the situation with Greece and Germany and the euro. But in this case, nobody's big enough to bail out the United States. And in fact, the rest of the world is looking at the United States and saying, dude, we want our gold. So by 1971, the US could not cover $3 billion of reserves. There just wasn't enough gold in Fort Knox to make that happen. Investors converted dollars to Deutschmarks. By 1973, it ended the fixed rate system. And so now, by 1976, with the Jamaica Agreement, we end up with a floating rate system. And that is the system that we operate on to this day. Now we come to our discussion of debt. Debt to GDP ratios mattered in the euro crisis, as we talked about. And US debt to GDP ratio is well over 100% now due to borrowing. So again, we have the benefit and the risk of interdependence. That is, the United States has access to capital, which supports its fiscal base. The downside is, at least potentially, is there are bankers that hold that. There are other countries who hold those assets. Is there a problem with not paying it back or with high levels of interest similar to the situation in Europe? Is this a problem? I will argue first that government debt is not the same as private debt. I know that there are lots of financial gurus and lots of politicians out there that say that the government needs to operate itself similar to a family budget or similar to the way a business operates, and those two things could not be further from the truth. That's not to say that you shouldn't be fiscally responsible, as we'll talk about here shortly, but that is really a false analogy. Privately, debt is a legal obligation to repay. The US, on the other hand, is a monetary sovereign. It can actually create money. So what burden does debt pose to a country that can continue to create its own assets to support itself? No family can do that. No business can do that. Only governments can do that. Debt is paid in dollars. And that's controlled by, in this case, the US government. As long as people have confidence in the US dollar, it's no problem. Governments also have indefinite forever lifespans. They don't have to pay back in any specific time. If you have a central bank, it acts as a buyer of last resort. There's no burden to the next generation, so to speak. So a national debt never has to be paid back. It could be rolled over indefinitely. That's not exactly true in all situations. EU nation states rely on a single central bank, just like American states do, but US states have to be accountable to the federal government, and likewise, the EU states also have to be accountable now to the EU. Treasuries are also like a safe investment. It's a bit like making a bank deposit. It might be safer to put your money in the US economy or by buying treasuries, than it is to put your investment in other sorts of private options. A lot of people talk about China owning a huge portion of US debt and investing quite a bit in US treasuries. Right now, it's estimated $750 to $850 billion of US debt is probably held by the Chinese. Believe it or not, that only occupies about 3 to 6% of the total debt. The number one holder of debt actually is Japan, not China. But maybe it's just a good investment, right? I mean, if you're the Chinese and you're looking to put your money someplace, maybe this is a good place to continue to make money. So there's nothing inherently wrong with a government increasing their debt without limit. It's not like the government has to pay it back. But that's not to say that this route is without problems as well. First, you have to be concerned about inflation. If you haven't watched the inflation video yet, please go back and check that out. What happens when you have levels of borrowing and spending that occur faster than the economy's ability to generate that? You end up with inflation, right? So the responsibility of Congress is to keep this debt manageable to the point, so and certainly from going up too quickly, so that inflation doesn't become unanchored. When Congress passes stuff and then doesn't raise tax revenue, it provides the impetus for inflation over time. So it is best for them to actually try to balance, maybe not balance the budget, but at least raise the money necessary in order to cover a good lot of the expenses that we put out there. Thus, Congress should lean more toward paying for the programs they want or for the tax cuts they promise. When inflation increases, then the Fed also increases interest rates, and there are adverse economic consequences to that strategy as well. The second is loss of confidence, right? Everything that I've said before is premised on this idea that the United States and the US dollar continues to maintain confidence. And if somehow that isn't the case, then maybe some of this logic goes away. One of the real costs of, say, refusing to pay our debts, well, and by the way, we have done that somewhat in recent years. It leads to a lower credit rating, which increases the interest rate. It causes us to potentially lose our credibility. Investors could hypothetically sell their bonds. They could crash the US dollar. And so these are all consequences of things that could happen if we are not more responsible with what it is that we do. But here's another variable, one that we don't often think about. Who's got the biggest military in the world? America. Yeah. Okay, so I shouldn't be ridiculous with this and mocking, but a lot of people sort of have that attitude that, America's big and strong and no one can mess with us. Well, there is some truth to that fact. If some of these negative financial aspects start happening to the United States, we still have our military to fall back on. And that's something that not every country in the world can do. Greece doesn't have a military substantial enough in order to back any threats by saying, okay, we're not going to pay off our debts, right? The bankers are stronger than that. But if the United States all of a sudden says, we're not going to engage in the international system and we've got a big military now, it makes it a whole lot more difficult for people to start just discounting the United States as being unreliable. So now I want to lead you through a hypothetical illustration of interdependence, demonstrating how changes in fiscal policy can affect the value of currency, which may have a potentially problematic effect for other countries throughout the world. What happens to the value of the US dollar when we cut taxes? When we cut taxes, that means there's more dollars floating around the US economy, which tends to create downward pressure on the value of the US dollar. There's more dollars in the economy. So what does that do to our buying power? Inflation goes up, value of your US dollar goes down. What does this do to the value of our exports as they go overseas? The answer to that is good news for those of us who are exporting things, right? It becomes more competitive versus other products. Value US dollar goes down. Let's say the euro is relatively higher. That means that now there's more incentive for Europeans to buy more American products because they seem like they're relatively cheaper. Hypothetically, let's say that the price of an American product declines in France, and the same product is being made by a French company, okay? Will that make the United States product more attractive? Well, yeah, from a financial standpoint, make it more likely, as I said, that people might want to buy that product. What happens to the producer of that product in France? Well, probably gets financially strapped because now they're buying more American products and less of whatever it is that France has to offer. How does that affect the people who work there? Well, people are probably going to start losing jobs, which means that French politicians are going to get in trouble. And so the whole thing, the United States, in other words, is over here passing tax cuts. And in the meantime, it's disrupting business activity in France and political activity in a negative way. This is one of the problems with interdependence. So how do the biggest economies in the world deal with that potential for conflict? The answer is we have a G7, or a group of 7 states, as it's called. That includes France, the United States, UK, Germany, Japan, Italy, and Canada. So what they do is they get together and talk about what their upcoming fiscal policies are going to be. So maybe the United States goes in and says, hey, this year it's quite likely that a tax cut is going to pass, or we're going to spend more money on this program or something, and that may have X, Y, and Z effect on the value of our currency, which may threaten certain industries of yours over there. And the French might then look at this situation and say, oh, okay, well, maybe we should drop our taxes too in order to offset that, or spend some more money over here so that the value of our currency sort of moves a little bit with yours. And so the bottom line is that they're talking to each other, they're communicating about these policies, and they may not like each other's policies 100%, and maybe it doesn't solve all of the problems, but it does mean that they're going in good faith, trying to communicate and trying to work these things out. Now, the G7 does a lot more than that. A lot of times they focus on something like climate change or debt in the developing world, and talk about solutions, like how can we make the economy, the global economy, more vibrant for all economies, because the idea is, again, based on liberal principles, that if these poorer countries have money to spend, then hey, that's good news for everybody, because that makes more purchases happen around the globe, and the entire thing becomes very dynamic, and everybody makes a whole lot more money. So that is really the intention of the G7, is not just to lift themselves up and to communicate with each other, but also to try to make sure that everybody else is doing well so they continue to buy our stuff. Now, the relative power of the G7 has significantly declined in the Trump era. As a result of having the United States take a more combative approach toward its allies, it's been more difficult to create cooperation in many of these forums. So as we discussed, when we have high inflation or a weak dollar, that should mean less outsourcing, a smaller trade deficit, more investment in the United States. It should also make foreign goods more expensive. So the United States products should be a little bit better off if they're made here anyway. I hope that makes sense. It's sort of like the France example, but we're running it in reverse in this case. But here's a question, a nagging question that I have about that. If I go to Walmart, the low value of the dollar should make me more likely to buy an American lamp than a foreign-made one, right? That should stimulate the economy, it should stimulate job growth, and it should alter the trade balance, and it should encourage foreign direct investment in the US. So why can't I find an American-made lamp in Walmart? One of the easy and obvious answers to that question is that American labor costs more, and through globalization, a lot of businesses have moved their operations elsewhere and have decided to make more consumer products in developing countries. So that's part of the deal, right? Another answer to this question is currency manipulation, specifically by the Chinese government. I'm going to show you this picture here. It's a picture of Chinese efforts to peg their currency to the US dollar. Now, before we get into the specifics as far as Chinese currency manipulation, let's just talk about it in general, right? So pegging a currency requires the same mechanisms used in any other country, so it has to manage its money supply. So if you want to peg your currency to another country's currency, then you have to engage in monetary policy, where maybe you're like printing money, or you're spending money, cutting taxes, engaging in fiscal policy to lower its value, or you're increasing interest rates or cutting spending or raising taxes to increase its value, right? All of those things affect the value of the currency, and that is what a country has to do. That's exactly the kind of thing that China had to do in order to try to make its currency float with the US dollar. Why? Why would it affect its currency, and what does that have to do with the price of a lamp in Walmart? Changes in currency value should make the United States, the value of a US lamp, seem more attractive to consumers. But if that currency is fixed, then they continue to move in tandem, which means that the American product is never going to be cheaper than the Chinese product. Prior to 2015, this was one of the primary strategies for the Chinese government to push their products cheaply into Western markets. But in 2015, speculators sold their yuan, crashing its value. It was a speculative attack, taking advantage of an inflated currency. And then China shifted to something that they called a dirty float. Less controlled, but still they had to control capital flows in order to try to prevent inflation. And then they shifted to a new approach, global investment through the Belt and Road Initiative. Massive program of building infrastructure and development loans to countries around the world. Are there ever situations where paying one's currency is not predatory? I would argue that maybe in some circumstances it might be solid policy. Consider Eastern Europe in the 1990s. Keep in mind, the Soviet Union had fallen, the Iron Curtain had dropped, and a lot of these Eastern European countries are now turning democratic. They want a more capitalist orientation, and they want to start trading with the West. And there are Western investors who are seriously looking at Eastern Europe and saying, hey, there's a potential market there, and we can get some cheap labor, we do all sorts of things there in terms of moving into Eastern Europe. Seems like a great plan. Problem is that if nobody has confidence in their currency, then nobody's going to want to invest in those countries. I mean, think about it, right? Why would I pour any of my money into Poland if, as a result of inflation there, I lose all of my money overnight? That means that in order for these Eastern European countries to become more attractive in terms of foreign direct investment, they have to control their currency. They have to make it a little bit more even. And so what they started doing is fixing their currency to stronger, more stable major currencies, often something like the German Deutschmark. And the way they did it is exactly the way that I just described. You affect your monetary policy, you affect your fiscal policy, and by proving to investors that you're willing to engage in the fiscal and monetary discipline to maintain your currency at that level, then it makes people know that they're less likely to lose a whole lot of money by investing in their countries. And it worked. It worked like gangbusters. Like, there was loads and loads of investment in these countries, and some of them became relatively wealthy, more democratic, you name it. Lots and lots of advantages to that. The challenge with that, though, is what price do people have to pay inside the country by adhering to those fiscal policies? So let's say, for example, that one of these countries has to change the value of their currency, and as a result, maybe they have to cut some social programs, or they have to raise taxes, things that are not at all popular. But it is in the interest of maintaining that currency relationship and continuing to encourage investors to come in and spend money. So you can see how this works. If I'm a voter and I don't like the fact that they're making me pay more in taxes, or they're taking my benefits away from me, who am I blaming? I may be blaming the government, but I'm going to say that they're in cahoots with the big investors because they're more interested in their interests than they are in my interests. Think the United States and China. The United States buys loads and loads of consumer goods, and we have a trade deficit, which a lot of people think that's a bad thing for us. Really, it's just sort of like a number on a ledger sheet. Probably doesn't make that much difference politically, but it is both a blessing and a curse to China. It's a blessing because, hey, they just made a whole lot of money, and isn't that great? We all like money. But that also means that their whole country is potentially awash in US dollars. And what does that cause? Inflation. And the way that it becomes inflation is that it changes from US dollars to their currency, right? So it becomes integrated in their economies. This is a really big deal to them. This is a political threat. They operate based on the principles of the Chinese Communist Party. They're an absolutist government, and they've got a lot of people on the poor end who are really on the outside of all this. And if you have inflation, not only do you make the poor poorer, but you have the aspiring middle class also taking a serious cut. So the Chinese government is going to do anything it can in order to try to prevent inflation. So how do the Chinese prevent inflation? All these dollars that are going to want to go over to the Chinese economy, they got to divert them. One mechanism is called a sovereign wealth fund. Sovereign wealth fund is a state-owned investment fund comprised of money generated by the government, often derived from a country's surplus reserves. So they take their money and they invest it in various businesses and various, construction projects, whatever, all sorts of things all over the world to prevent that money from coming back to China, but also to sort of like keep it in safe reserve. Likewise, maybe we're going to buy US treasuries. On a sovereign wealth fund, you're hoping that this money is going to sit here in what is essentially an account and hope that that money is going to multiply over time, making you even richer in the long run. But there are other ways that you can spend your money as well. One is to underwrite the debt of a lot of countries in the world. Think about it. There's a lot of impoverished countries that want the backing of China, and China will help them out. They will buy up their currency, or they will make sure that banks give them money to do the things they need to do. They've done it around the world. They've done it in Africa. And in fact, most of what we would argue that they invest in are what are considered conditional loans or conditional contracts. My friends in the military call this death trap diplomacy. The idea that is that you're paying to play when you're working with China. They'll give you money, they'll give you construction projects, they'll do things that you think are good for your country, but they're going to want something in return. Or maybe the terms that they started off with may not be the terms that you end up with. And the United States, in the meantime, also engages in similar policies. Like, we support different countries as well. The United States, on the other hand, has generally been more respectful, we'll say, in terms of that aid, that those aids don't come with conditions, and that makes them therefore more attractive. But what comprises U.S. foreign aid is an interesting question, and that comes in a couple of forms. One is humanitarian, and the other is military, and most of them are in the form of subsidies. What do I mean by that? Well, we aren't just giving this stuff to other countries. Somebody has to pay for it. What we do is we take our tax money, or whatever money we borrowed from the Chinese or from anywhere, right? We take the money that's in our budget, and we don't pay them, right? We pay the producers to make it and give it away, right? So this essentially is money that goes to the makers of fighter jets, or to farmers who are sending that food off to other countries. So U.S. foreign aid, it's important to point out, most of it isn't money that's going overseas, it's money that's going into American businesses that are then giving those products away because now they're paid for. That's been a long-term argument on behalf of many politicians in Washington is, should we be spending that much money on foreign aid? Well, the fact is the amount of foreign aid in our budget is less than 1% of our total budget. It's a very, very small and insignificant number. The problem is that the United States has cut its aid way, way, way down, while the Chinese has built themselves way up. So if you're a country and you're interested in getting some help from people, what are you going to think about the United States versus what are you going to think about China? And what does it matter? Hopefully, this discussion has led to some additional nagging questions. What kind of a picture of the world does all of this information now paint? Does it make you nervous? It also may make you wonder, what really is motivating companies and countries? Is it exclusively profit and savings, as liberals would argue? Or is it something else? And finally, how does this mesh with liberalism? Or does liberalism fail to account for some aspects of this? So if I were to ask you, what do you think that driving force is, maybe, behind all of this? You might answer, power. When we're business people looking at the global environment, we're not always thinking about that power component. We're more interested in profits and so on. But to ignore it would be potentially to ignore opportunities, but also perils when it comes down to investment and looking at how economies actually work. All right, what did we learn today? First, we learned that liberal trade policies produce interdependence, which comes with some incredible advantages, but also comes with some significant risks. we rely on global cooperation to try to offset those risks. And we undermine these institutions really at our own risk. We may increase our level of risk if we continue to act in a way that's adverse toward those global institutions. At the same time, when some countries like China abuse the globalized international system by exploiting or breaking the rules of the free trade system and accumulating power, then maybe we need to be concerned about power too. And the next video is going to do exactly that. We're going to talk about the second major theory of international political economy, which is called mercantilism, a theory that is primarily concerned with power.